Hello and welcome back to another episode of Trust Issues, a podcast by Kepler Trust Intelligence. Before I introduce this week's guest, a quick reminder that past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that independent financial advice should be taken before entering into any financial transaction. And with that, I hope you enjoy this episode. Hello everyone, and welcome back to another episode of Trust Issues from Kepler Trust Intelligence. This week I'm joined by Dave Baxter, who is probably familiar actually to most people listening. He's the funds editor at Investors Chronicle. So Dave, thanks very much for joining me. Today we'll be talking probably about a few things, but I think to start with, we'll talk a bit about a piece you wrote, I think, last month or a couple of months ago. And that was looking really, I suppose, at whether or not there's room or a bounce back, whatever you want to call it, for, I guess, like one-stop shop style investment trusts, generalists that maybe had fallen out of favor a bit over the past decade. And also you touched on more specialist trusts, so something like Taylor Maritime or something like that, and whether those will stay popular. So could you maybe talk just briefly, I guess, summarize what the argument you were making there was, if that's possible?
Yeah, sure. Thanks for having me on. I suppose it's kind of interesting because investment trusts in some ways now are used to capture some of those interesting new trends. So you mentioned, I guess, quite niche things like the shipping leasing, or you have things like Seraphim Space, quite future-focused ideas, and Scottish Mortgage, I guess. But you do still have those kind of stalwarts of the sector, so names like F&C or Alliance Trust, which, as you said, and as we discussed in the piece, they're kind of viewed as, in theory, they should act as a one-stop shop. So you can either stick all your money in them and you have kind of like a broad exposure to things like global equities, or you can at least use it as like most of what you're invested in, and then stick some specialist exposure on the side. But the issue, as you mentioned, is that they've kind of, if we're talking, I guess, maybe a couple of years ago, then they spent kind of various years languishing against something like a global equity tracker. So you'd kind of ask, are they still relevant? What's the point of kind of using them now? But now, I looked at the data this morning, and if you look at kind of performance to, say, middle of November over the last year, they're still not always doing fantastically. Obviously, it's been a very difficult year, but they're just holding up better against the MSCI World Index. And the point I'm kind of exploring is whether they're more relevant now, and also whether you can maybe expect them to kind of be worth investing in as opposed to a tracker. Are they going to kind of either outperform over time now, or equally, are they just going to give you a bit of a kind of smoother and better balanced ride? And I guess we can, sort of discuss why that might be.
Yeah. So, I mean, I think it's interesting you bring this up, just because recently I wrote something which I'm sure everyone listening has read as well. But that was more talking about how, if you look at the past 10 and arguably even longer than that, like past 3 decades, you've just had this big debt-fueled, I don't know if bubble is the right word, but basically like low interest rates, lots of easy access to cheap credit, basically, and that's kind of created an environment where, one, you have rising tides lifting all ships kind of thing, and then also just created massive companies trading at just massive valuations, because if interest rates are really low, then you can discount things in that way, and that just seems to be coming to an end. And one result of that may be that beyond a lot, partly because of the more difficult economic environment, where basically you actually have to make money now, and you can't just rely on continual funding rounds and cheap access to credit. That's one facet where there's more winners and losers, and also you just don't have that rising tide lifts all ships type environment where that. So if you think about someone investing in a tracker, that can end up working quite well because it's just okay, everything's doing well, everything's going to go up. But maybe there's more room for finding winners and losers, and as a result, active managers moving forwards. I don't know if that wasn't the argument you were going to make, but it's sort of perhaps related.
I think that's definitely part of it. I think it's kind of there's a couple of elements. I mean, one is about style. So you mentioned that kind of low rates, and that's been very good for, as we know, for kind of growth investments and kind of companies where you think there's great kind of future performance, and therefore you're like paying up for that, and it goes up and up and up. Whereas I suppose now you've finally seen, and this is that perpetual debate, isn't it? But you've finally seen kind of more cyclical assets do at least better relative to growth, and people are now worrying about things like discount rates on like the big tech stocks, and I think that's probably one of the main things to consider if say you were kind of weighing up a MSCI World Tracker versus these kind of funds, because one reason they've lagged in the past is because you still have that issue of MSCI World Index is still so heavily weighted to not just the US, but to those big US tech names, the FANGs, Microsoft, and so on. And at a time when they were just kind of, there have been many times in recent years where stock markets are doing well, but people have pointed out that, say, much of the performance in the S&P 500 has been driven by just 5 companies or so. So, if you're an active fund like Alliance Trust, you're trying to do something different. You're trying to diversify across different styles. And at Alliance Trust, for example, they try not to become overly weighted to growth or value funds within their portfolio. They back managers of different stripes. So, at a time when everything's driven by the FANG stocks, then those funds are going to look quite kind of underwhelming. But then, if you do get more dispersion and if the market becomes more balanced, and as you say, if you do get that kind of dynamic of stock picking starting to make more of a difference, then in theory, you should have a bit of a better time with these funds. But again, that's such a difficult debate, isn't it? Because you can think even before the sell-off and even before interest rates were rising, we could have had the conversation any time in the last 5 years, maybe most of the last 10 years, about whether those US stocks are overvalued, whether the fundamentals are there and all that kind of thing.
I think that's a good point, which is a lot of the time when people say, oh, if you had just invested in whatever, if it's like an S&P or MSCI tracker, and they'll look back at the past decade and go, oh, it was so obvious. But even 3, 4, 5 years ago, there was a very good argument to be made that, and possibly that has now been proven correct, that lots of those companies were, as in the FANG companies, were quite overvalued. And so it's sort of like a hindsight. I think a lot of the time you have a hindsight bias thing where it's easy to go, oh yeah, well, if I'd just done that, it would have been really, really simple. But actually, in the moment, it's not really that obvious. And so that, which I think in a way plays into the strength of these funds, right? Which is if you were someone even 3-4 years ago who was saying, actually, I don't really want it to have massive exposure to US growth. In hindsight, maybe you could say that wasn't the right call to make, but that was still something that people were saying, and that was still a valid call to make. So yeah, I think it's often not as straightforward as it seems with looking through the rearview mirror type of thing.
Yeah. Well, it's like you mentioned all these kind of trades unwinding because of rising rates, and I was speaking to someone recently about the huge, slightly different, slight divergence, but I was talking to someone about the massive sell-off you've seen in bonds, and they made the point that, of course, really people should have expected that if you've got bonds on kind of negative yields, then there's not really there's quite a long way that prices can fall if things go wrong, but then it's kind of maybe it speaks to the psychological challenges of investing, because if you're if you've been just in a tracker or something, and you've made huge returns, and all these funds that are doing things differently and trying to take a more balanced approach look quite weak in comparison, then it's very easy, I think, to kind of buy into that narrative. And equally, I suppose there's been concerns raised that get plenty of kind of fund managers and investment professionals who, I suppose until recently, had never known in their careers a period when you didn't have kind of ridiculously low interest rates, and it becomes it's almost a kind of psychological blind spot because you can't really consider things being different.
So, I mean, maybe to go back to a piece of it, I mean, do you think we've reached the end of this FANG growth dominance and that there will be a sea change, or do you think it's more of a temporary phenomenon and that will just revert back to buying US tech once again?
It's really hard to call, isn't it? Because I think what's been interesting this year is if you speak to a lot of investors, they're still, normally when you've seen markets fall and things like the FANG stocks fall, then people go into the mode of kind of buying the dip. But people aren't necessarily doing that because it still feels like even now there's uncertainty about the extent to which rate rises will crank up, and the extent to which that will kind of hit those business models, and also the extent to which we've potentially kind of overvalued those stocks in the past, and what is kind of like a fair value for them. But then equally, on the other hand, tech is still ubiquitous in our lives. I mean, it's not like our lives are going to become less digitalized because you've had interest rates rising. So yeah. I think there is a strong argument you could say they would come back, but I don't know. I mean, if the macro environment is particularly different, then maybe it is maybe we are going to see less of that kind of imbalanced, market makeup. I've basically not given you an answer because it's kind of
that's okay. It's a wise move to not try and predict the future, I think. I mean, and so to go back maybe to the other point that you make in the article, which or the other thing you discuss is really specialist funds. So again, that could be something like shipping or like forestry. I mean, it feels like there's almost any kind of niche area, which is, I think, a really interesting or positive feature of the space. But then I think the question you really looked at was how much exposure should you have to those sorts of funds? I mean, relative to the other funds we've discussed. So if you think of, I mean, what are your thoughts there? Are we basically saying that the more generalist, so let's say like an Alliance Trust or Brunner, something like that, should really be the core, and then you have sitting around that smaller exposure to shipping or forestry, whatever tickles your fancy?
Yeah, I think that makes sense. Having kind of a lot of your portfolio in something relatively broad, whether you are a fan of something like a tracker or one of these kind of investment trusts or a handful of kind of maybe more conventional funds focusing on things like equities or traditional assets, and then having what's referred to as, I guess, kind of satellite holdings of smaller positions in those more esoteric funds. I mean, again, these things are quite individual in terms of like how much you would allocate to those funds. I've previously spoken to people who said, with kind of alternative asset classes, and obviously that covers a lot of areas, but with alternatives, you might, for example, not want to put more than, 5% of your portfolio in one particular fund, whether that's something like infrastructure or some of those more esoteric areas that you mentioned. But I think it depends on your preferences. And, maybe you're an investor who loves the space theme or loves the forestry theme or whatever it is. But it is worth noting that in theory, well, not just in theory, in practice, these specialist funds can be so idiosyncratic and very exposed to kind of, their own specific trends, which means that they can have quite big ups and downs, and potentially more so than you would see in a broad fund. So I think I mentioned in the piece, you've had, you mentioned kind of the shipping funds have done kind of relatively well this year, and there have been some really niche funds, like a merger arbitrage trust that, when I last checked, had done really well in the last year or so, or things like BH Macro. But then, on the other hand, you can see the idiosyncratic risks with, say there was, Civitas Social Housing last year. That was a very popular fund. Or things like Tritax Big Box this year. They're kind of focusing on very interesting themes, but then they run into like their own specific issues, and you see them move from being on a big share price premium, being very popular, to suddenly absolutely falling out of bed and making quite big paper losses over a relatively short period. So you just need to realize that you're more likely to be massively up or massively down with those kind of funds than with, something broad. Although volatility is everywhere, but that is the idea. So that's why I suppose core and satellite can be a kind of slightly easier to live with approach. A bit less stressful if you're someone who sort of checks their
all in on shipping.
Yeah, exactly. Betting big on shipping.
Yeah, interesting. I mean, maybe to close off this part of the discussion, are there any trusts in the specialist area that you think are looking, I don't know, particularly interesting at the moment, or in the same way that there might be something of a sea change in the broad equity space where US exposure becomes less of a big deal and more room for active management? Are there any specialist trusts that you think look, I don't know, particularly capable of handling like a very tough economic environment, potentially recession, that sort of thing?
Yeah, it's hard to tell. I think there's maybe two sides of it. So one is you have those, you have very niche funds that have tended to prove pretty resilient. So I don't know, one name to kind of pluck from the air is that's tended to look quite sturdy, but is very niche, is something like biopharma credit. They kind of lend to, well, they focus on kind of life sciences debt, and they've tended to look quite resilient and been known for their kind of quite strong due diligence. But as I said, anything like this, you're going to potentially get your very, very sector specific risks that might kind of creep up on you and you might not be able to predict. And then, I don't know, the other side of the coin is if you're kind of long-termist, what still looks interesting? If, as with tech, I was saying that's still a interesting trend. Could you argue that, say, Tritax finally looks interesting because logistics and e-commerce, it may be kind of vulnerable for now, but in the long term, it's still a thing that isn't going away? Or equally, the private equity trusts are on such massive discounts at the minute, and they could look vulnerable in a time when kind of debt is not ridiculously cheap anymore. But if you can handle it, if you can kind of sit in there for a few years, then the kind of trends they're focusing on, like the secular growth trends, should still hold up.
Yeah, I think that's something we've seen in general across some of these more specialist trusts, is that in the past, let's say 12 months, quite a lot of them have just the discount has opened up massively. That's true of some other more like generalized, not so niche funds as well. But I think in a lot of cases, it's not necessarily you look at them and go, oh, that's gonna really blow it out of the water. I can't believe it's on such a wide discount. But it's more like the discount is so wide that it feels as though there's not that much left to price in. So it's you can completely see that some trusts may not immediately bounce back, and there might be, in terms of the NAV coming down, that's always possible. But because the discount is so wide, it's almost like that's priced in, and it sort of acts like a cushion on further losses. potentially. I could
Yeah,
also
yeah.
be completely wrong, and it might just get whacked even more. But that seems to be, I've seen that across quite a few sectors, and like not that aren't really related at all. So it's definitely a thing that seems to be happening.
Yeah, it is. It does seem quite indiscriminate, doesn't it? The huge discount widening, but then it feels like any area where you have any uncertainty, then that's getting priced into the extreme. So, as I
Yeah,
mentioned, some of the PE trusts are on something like 50% discounts, and they've always been on, for many years been on big discounts anyway. But that is
yeah.
absolutely enormous. And I suppose, like you say, it's just yeah, people are pricing in the worst.
I think that is definitely what they're doing. Um, Okay, well, maybe to move on to a slightly different topic, we're going to talk about global equity income. So,
Yeah.
if we've talked about stuff that might perform well, I think the point here is more that they seem to be holding up well, as opposed to smashing it out of the park. But so, can you talk a bit about that? Why do you think that's happened? What are some of the dynamics at play there?
Yeah, it's just quite interesting. So, we're talking global income, but income in general, both in the investment trust space and in the open-ended space too, that's something that has tended to be a bit sturdier in the last year or so. So those are the kind of funds that have either somehow eked out a positive return or have had less of a bad year, which is for many investors perhaps one of the better outcomes. I think it's probably a combination of two, or I guess maybe two slightly different trends. So one is some income funds have kind of captured they've just got exposures to kind of sectors like energy and some of those few sectors that actually have kind of benefited in the inflationary environment we found ourselves in. So those have done well. Quite cyclical exposures. But then on the other hand, you've had the kind of, I suppose, less yield focused, less high octane funds that focus on maybe companies that aren't enormously exciting, but companies that kind of keep paying out a dividend, maybe kind of companies in older industries, not kind of glamorous stocks, but those are, for example, things like consumer staples or various, utilities, stuff like that. But those companies, I think, perhaps have become a bit of a haven for some investors because they're very well established companies. They've held up for a very long time. They're quite well kind of capitalized, and therefore they look like, and they often kind of offer things that should, continue to chug along even if we do go into a recession. You get the kind of fund managers joking about people will still brush their teeth in a recession or that kind of thing. So you've got weirdly those two different schools or cohorts of income funds are kind of doing quite well. And then if you look at if you glance at the kind of global equity income sector, you've had like some quite good results. So if you look at kind of 1 year returns, Murray International, which was kind of, I guess it's been a bit different, a bit contrarian. It's tended to focus on kind of companies in areas like kind of Asia, and it's been less focused on, say, the US. So it has had a bit of a kind of underwhelming time before the last year or so, but now it's massively returned to form. It's performing really strongly. Anyone who's in that is quite nicely up. And then you have, a few other names have done pretty well. So as we know, it hasn't been the best year for Baillie Gifford, but the Scottish American Trust, their global income fund, that has done relatively well. It's kind of flattish on the year, which I think is a good result. And then you have names like a very popular trust recently, the JP Morgan Global Growth and Income Trust, which has been sort of gobbling up some of its peers. That's a little bit down, but I think being a little bit down is kind of a relatively good result. And they have, these funds all have slightly different approaches, which is quite interesting. But it's probably worked out quite well if you're say if you're kind of an investor who is kind of reliant on their portfolio for income, say you're kind of not working anymore, then periods like these, I imagine, must be enormously stressful because you don't really want to be like dipping into your portfolio at a time when everything's down, because of course you then erode the value of it, and that can have massive negative implications for your future income.
Yeah.
But at least now, these funds have held up relatively well, and they've continued to kind of pay dividends. So
Yeah.
you've
Well, I mean, what?
gotten through it better than you might expect to have.
Yeah. I mean, one of the things you mentioned there was you said they take different approaches. So can you maybe talk about what those are, and if possible, have you seen any? I don't know. Have you seen that any particular style in the space has been managed to hold up better than others, or anything like that?
Yeah, so I suppose, like I said, kind of Murray International's been a bit more contrarian and maybe kind of exposed to some of those areas that have not seen the kind of reversal of the last year or so. And kind of, they've focused on regions that aren't always that well represented within a global income fund. Sometimes global income funds can be a bit beholden to the kind of makeup of the MSCI World Index. So in recent years, if they've decided not to have a massive weight to the US, as that index does, then they've ended up kind of underperforming. Slightly similar story to things like Alliance Trust, as discussed before. But say you look at Murray International, in its equity exposure, something like a quarter of that recently was in Asia, around 20% was in Europe, around a quarter in North America. So quite different. And I suppose it also stands out because it has quite a low allocation to the UK. So it is something a bit different if you're someone who already loves a UK income fund for those nice yields. And then, turning to the JP Morgan fund, that's quite an interesting one because they're quite flexible in terms of their style approach. So not too long ago, they were kind of they had a decent amount of exposure to some of the kind of US tech stocks and some of those growth names, but they've been kind of shifting with the times a bit. They lightened up on those names and moved more into kind of reopening plays in the earlier pandemic, and they've been kind of, to an extent, having a foot in both camps also. So they've had exposure to some of those big tech names, but they also have more kind of cyclical holdings. So that has worked out relatively well. Although I suppose it's good to remember that, if you're dependent on a team calling market shifts, then there might be times when they get it wrong and you're going to struggle. But I suppose just one other thing on the approach is, and this is an interesting debate in the income space, is some funds still go for kind of what's called natural income. They just get the dividends from their underlying companies. But the JP Morgan fund, in line with some of the other trusts run by JP Morgan, they basically kind of pay a set percentage, I think around 4% of NAV over the course of a year, based on like a set date, I think towards the end of the previous year. And that's more of a kind of total return approach. So rather than chasing after yields and potentially ending up in more cyclical sectors or, taking risks, they will more focus on a company that they think is good. And then they can kind of, I suppose, generate the income via a combination of dividends from the company, and if they need, they can use kind of capital slightly, and that comes with risks if you're down. So there are some trusts that have struggled in the last year or so, and they tend to use capital to an extent to pay that. So that is a risk, but it's worked quite well for them so far. So
yeah. No, I think that seems to be a increasingly popular. I mean, in theory, I think it makes sense, right? Which is if you're being constrained, where you're You're only investing in something because you think it will give you a good divvy versus you actually think it's a good company.
Yeah.
Maybe I mean, maybe that binary option, binary choice is not actually there. But I think speaking to managers at different trusts that take this approach, it does seem to make things a little easier for them because they don't have to have in the back of their head always, am I going to be able to get the income I need from this?
Yeah.
But as you said, that doesn't mean there's no risks, and
It can be.
Those are their wells.
Sorry, I was going to say it can definitely be an approach that works until it doesn't work. So you had.
Yeah.
I was thinking, a few weeks ago, you had Princess Private Equity. They're one of the names that have stood out from their peers because they do pay a dividend, but private equity, that's slightly difficult because you're partly reliant on realizations, and they took a big hit on currency hedging, and then maybe there's a risk of realizations drying up, so they've had to pause their interim dividends. So, that can become a problem.
Yeah, not without risks, I suppose, is the message. It's the message there.
The caveats.
Okay. Yeah. Okay. Well, maybe to finish off, this is actually something I was talking about with one of my colleagues earlier this week, which is I think trusts that sell themselves as wealth preservation type funds. So I think Ruffer is probably the big standout there this year. The question we had was basically, should you risk going with something that's more, let's say, over the past decade, let's say it would have been something more growth oriented, and you're going to have to deal with you will probably have to deal with a drawdown, or should you just stick with something where they're very good at avoiding drawdowns? So maybe you can come up with a better answer than we had. I don't know. What are your thoughts on this space?
I think these funds serve a particular purpose, I guess, don't they? Because they have some equity exposure, and then they use things like bonds and gold to try and give you a smoother ride when things get rough. I think it depends on how much time you have to kind of wait out market ups and downs, and also how much volatility you can tolerate. So I think things like Ruffer are probably especially good if you're kind of older and you want to start. You don't really have that time to wait out 10 years for your equity investments to eventually come back to where they were, and you're investing along all that time and getting pound cost averaging. So it's, for me, I think that would be the kind of dividing line. Like if you get hugely stressed out by these falls and you can't deal with it, then maybe you do go for that more defensive approach, but you have to accept that you're kind of potentially limiting your end returns over a longer time period. But I think they serve quite a good purpose for a certain demographic, and I say it's been quite interesting looking at Ruffer, because again, that's another thing that has looked quite unexciting, underwhelming for many years, and for a very long time they've been worried about inflation, about things finally coming crashing down, and now they're right, and they look really good, and they look really kind of well placed. But you could have read their commentaries on this subject 5, 6, 7 years ago, and if you were kind of in a tracker or wherever, you would have just kept making absolutely enormous returns and feeling quite clever about it. What was your kind of conclusion, or did you
I think basically that Ruffer's similar strategies are impressive. I mean, if you look at Ruffer's performance over the past 2 decades, you almost can't pick out when there's been a major drawdown in the market, which I think is
wow.
I mean, you probably could a tiny bit, but they really have done. It's like it does what it says on the tin, kind of fund. So I think that if in that sense you have to respect them, and I think also if Nassim Taleb, the Black Swan guy, always said all that matters in investing is the drawdown, and I think if you see things that way, then these funds will appeal to you. But that was the point you made, was also one that I brought up, right? So I'm in my late 20s, I can probably afford to take on a bit of risk. In contrast, if I was my dad is almost retired and is I won't say how old he is, but he probably on way to. But I think he would probably not. There's no way he would want to take on the same level of risk as me, and so he would probably find that more appealing. But that's not to say that I don't find it appealing, if that makes sense. I think that it is really impressive what they've done, and I think even if they were early or in talking about some of the things that are now playing out, the fact that they were talking about them, one gives you some confidence that they know what they're talking about, and also it's one thing to predict something; it's another thing to actually be able to take advantage of it. But at least if you were expecting it and had managed to roughly figure out what dynamics were going to come into play to cause the situation, say that we find ourselves in today, I think that's probably quite reassuring as well, because you can go, okay, if this guy, if these managers actually had some idea this was coming, yes, that's not a guarantee that they're gonna absolutely blow it out of the water in the years ahead, but at least they're sort of prepared to deal with it. So I think that is another, especially today, that's probably something else that people are finding appealing.
Yeah. This is, this is very kind of hindsight-led question, I guess. But if you looked at those 20 years, what was the gap between Ruffer and, say, if you had been in, some sort of all equity vehicle?
I honestly, off the top of my head, I can't remember. I'm looking at. I've pulled up the price now, so it's not. I wouldn't say it's entirely accurate to say that they saw no dips, but definitely relative. Yeah. For sure. And if you look at, say, the past 12 months, right, or if you looked at actually also when you had that big crash at the start of the pandemic, and also in financial crisis, the late 2000s, again, it's like you can sort of see it, but it's nowhere near as impactful as it would have been for like some growth equity or whatever general equities fund.
Yeah.
So it's a tough one, isn't it? It's an interesting. Maybe that could be. You could write your next piece about that.
Yeah, good idea. Yeah, okay. I guess one interesting note is just that there is that theory, isn't there, that the amount of drawdown you limit when things fall has a massive impact on your returns. So it'd be interesting to see, how over the long run they actually do kind of look versus something that's a bit more risk on. Yeah,
as I said, I off the top of my head, I wouldn't be able to give you the figures, but something worth looking at.
Yeah,
cool. Well, I think we've been going actually for quite a while now, so that's probably a good point for us to stop. So, Dave, thanks very much for taking the time to speak to me, and hopefully we can have you back again at some point in the future.
Yeah, great. Thanks for having me.
You've been listening to Trust Issues by Kepler Trust Intelligence. You can subscribe to the podcast on Apple Podcasts or Spotify. Remember to visit our website at trustintelligence.co.uk to keep up with all the latest research on investment trusts.